Welcome back to the Finance Now podcast. This podcast is purely for informational and educational purposes, and it's my way of sharing my knowledge, research, and opinions with you. I'm Anurag Birla, and today I want to explore something that I'm very curious and passionate about: streaming and the entertainment industry. More specifically, I want to look at Q1 and Q2 guidance from some of the big names, going back to Netflix, Paramount, Warner Brothers Discovery, and of course, Disney, and also talk about how the streaming industry has or is shaping up. So let's start with Netflix. It's been a while since they reported their earnings. It was April 18th. To summarize, they basically met analyst expectations when it came to revenue and earnings. Shares tanked 10% on the profit outlook going forward, but they did recover to a smaller loss subsequently. They added about 1.75 million subscribers during the quarter, which is a significant decrease from nearly 8 million subscribers added in the previous quarter. Their earnings guidance for Q2 fell short of expectations, and for the first time, they refused to provide guidance for subscriber expectations. So overall, we see a slowdown in new subscribers, which is understandable given the number of streaming services out there at the moment. And subscription fatigue is a real problem nowadays. In 2022, Netflix for the first time saw a decrease in subscribers. So let's look at how they've addressed it. They decided to roll out an ad tier, a less expensive membership tier that has ads, and they've also initiated their password sharing crackdown, which for the long term seems to be a big opportunity. For context, about 43% of its user base share accounts, which has supposedly affected Netflix's bottom line and their ability to invest in new content. They've been running some trials in different regions, and I guess results are looking encouraging. Greg Peters, co-CEO, mentioned that he believes subscribers will initially cancel, but eventually return by signing up for their own accounts, likening it to a price increase. It's clear that Netflix is prioritizing profitability over subscriber growth. I mean, with an already massive subscriber base of over 232 million, I think that's a much better priority to ensure they're actually maximizing revenue out of their active subscribers. After the whole Love is Blind live stream troubles, whether they expand more of their offerings into the live streaming space as well is, another question entirely about the direction, trajectory of the business. But with Netflix, though, there's a lot of uncertainty. I guess management has refused to provide specifics on, ad tier forecasts and some other forward-looking information as well. But with all these changes, we have to expect better profitability. A short-term contraction in subscribers and revenue, but a long-term growth in all aspects, including net income, would cement Netflix's position as a dominant player in the streaming industry. Sticking with the theme of the podcast, let's talk about Paramount Global. Last week, shares fell over 28% after a weak earnings report and a dividend cut. Both earnings and revenue missed analyst estimates, and as far as the dividend cut goes, the company is cutting its quarterly dividend from 24 cents a share to 5 cents a share, almost an 80% cut. Now, that's the first time since 2009 that Paramount has reduced its dividend. To put into context, I totally understand the necessity of this move, but it just doesn't look good, does it? Their traditional TV revenue was down 8% in the quarter. Film studio division revenue dropped 6% year over year, and as Paramount tried to stabilize their streaming business and cut losses there, the dividend cut seems like a necessary move in order to save cash. Of course, as investors, nobody likes dividend cuts, especially ones of 80%, but I think it speaks volumes as to where Paramount are as a business and how they are faring in the streaming race. CEO Bob Bakish mentioned that the company is hoping to stop streaming losses by the end of 2024. With this year being the peak for losses in Paramount's streaming business. Paramount Plus, which is what their streaming business is called, revenue for Paramount Plus grew 65% year over year, and it reached 60 million subscribers. But their direct-to-consumer unit losses widened from 456 million a year ago to 511 million. They also incurred a $1.7 billion loss in connection to integrating Showtime with Paramount Plus. With Paramount, though, their streaming service has potential. I mean, I guess purely based on everything they're involved in. The access to their originals, various other movies and TV shows, and sports as well. I mean, through CBS, they have the Formula One deal, the NFL, the Champions League, IPL, and golf, which is all part of their CBS offering, their package offering. And, for someone like me, who's an avid sports fan, that would probably be enough to tempt me to subscribe. They also have South Park, which I love so much that I decided to name this podcast episode after a South Park episode. Overall, they just don't look like they're in a good position at the moment as a business. I mean, a lot to sort out in terms of making the streaming business profitable, but I do think they have the content. They have, I guess, the core ingredients. It's just a question of navigating, that ship now and whether they can do it in a timely and successful manner. Warner Brothers Discovery announced a wider first quarter loss despite their US streaming business finally turning a profit. The stock closed 4.5% higher last Friday. And for those that aren't aware, Warner Brothers Discovery owns HBO Max and Discovery Plus, but are launching a new service that combines the two of them, calling it Max. Pricing will be exactly the same as current HBO Max plans, and it should launch May 23rd, if I'm not wrong. Now, while the US direct-to-consumer segment turned a profit, the international streaming business still lost money. CEO David Zaslav mentioned that the segment will break even by 2024 and be profitable in 2025, and he's aggressively cut on content spending in order to jumpstart that profitability. He seems fairly confident about his timeline, which is a good sign, but also I guess we have to take into consideration that these are just his projections. Much like Paramount, Warner Bros. Discovery also has exposure to, various different streams, news, sports, which hasn't yet been added to the Max package. They also look like they have a diverse range of assets and content. And, as the industry pivots to predominantly streaming away from cable TV, they look well positioned to turn profitability. Purely in terms of content, I would say Warner Brothers Discovery are winning the battle. I mean, the likes of, Succession, Game of Thrones, House of Dragons now, the entire Harry Potter franchise. And, they own DC as well. If they can sort themselves out with DC, it would add so much. And I guess altogether it builds up to a lot of potential in terms of the kind of content that they can create and monetize. Based on their competitive positioning, restructuring, and their now better looking finances for the streaming segment, they look like they're on the rise here. They look like they're on the up. And if they can achieve their targets of profitability by 2025 while maintaining quality over quantity in terms of shows and content, they'll be incredibly well positioned a few years down the line. Now, I can't talk about entertainment and not include Disney in the discussion. So let's talk about them. Disney released earnings on Wednesday, 10th of May this week, and after hours, the stock was down about 5%, and the next day dropped to about 8.5%. For a second, I just want to stray away from the theme of streaming. Disney parks continue to be a strong positive with an operating income of $2.17 billion. No surprise there, as I guess people still seem to be on that post-pandemic high and want to be going out and getting that in-park experience. The trend was also evident with Universal Studios at Comcast, so no surprise there with the parks. But going back to their streaming business, what may have spooked investors was the fact that the Disney Plus subscriber numbers actually missed expectations amidst amidst the recent price hike. They didn't just miss expectations. The service actually lost 4 million paid subscribers during the quarter, which was the biggest drop ever, especially when, compared to estimates of an increase in subscribers by 1.7 million. It's weird because obviously the loss of subscribers is not ideal at all, given that Netflix are still gaining subscribers and so are the other competitors. But their streaming segment losses reduced and their financial performance did seem somewhat better. Bob Iger, the CEO who returned at the end of last year, has been incredibly focused on profitability and margins, which is not a bad deal given that the company's direct-to-consumer division had spent, $33 billion on content last year. Iger's been working on multiple revenue streams with price hikes, and much like Netflix, Disney Plus have launched the ad tier. Disney is also going to be removing some of its content. So quite like Warner, they're shifting to a lower volume but higher quality bracket. They're also going to be bundling Hulu Plus with Disney Plus into a single streaming app, which I think is a great idea because people are probably getting exhausted with some of Disney's content. They have been so heavily reliant on, franchises like Marvel and Star Wars that, going to Disney Plus for new content is almost unheard of. No, people usually go back to Disney for like nostalgic reasons or to watch something that, they've seen before and are familiar with and wanted to kind of rewatch or stay in that world. So I think this bundling with Hulu Plus is going to help Disney in terms of their subscribers because they probably want to expand the type of content that they're releasing as well. The overall streaming industry seems to be in an interesting phase of its life cycle. It's grown at an incredibly rapid rate in terms of subscribers. Everyone has adopted and accepted that it's going to be the future. Cable TV is a dying business. Companies have now invested so much money into creating their own streaming setup and offering. And I think the next phase is really going to be weeding out the weak ones. I reckon there will be consolidation in the industry, some M&A activity, and we will see some interesting moves by various studios and companies. Subscriber fatigue, as I mentioned earlier, is a real thing. No one's going to be subscribed to 4 or 5 platforms. It's going to get annoying. Well, to be honest, it's already annoying. So joint ventures, acquisitions, whatever it may be, I do expect to see some of that within the next few years as these companies start to get, their streaming segments in full-flowing operation. I think one of the biggest benefits companies can have at the moment going into the next few years is diversification in terms of income. The players that have income streams from the likes of entertainment, sports, news, etc. are probably the ones, in my opinion, that, if they can successfully restructure and sustain profitability while producing good content. And I can't stress how important producing good content is. I think those are the companies that are best placed to win this race. Now, this is not to say in any way that, Netflix aren't a front runner. The content that Netflix have pushed out, the international production opportunities with Netflix South Korea and Netflix India, they obviously have the head start in the streaming business, and none of that can be overstated. It might actually be too early to predict, but in my opinion, I think Netflix with about $8 billion in cash, they're front runners to make an acquisition that in some way or the other diversifies their income stream. I do also think one thing to keep an eye out for is the writer's strike. Now, I don't want to get into it too much. There's a lot of information on Google if you want to know more about it, but it does affect these companies on a financial level. And if the directors and the actors, after the guild for those two sets of groups of people meet, if they also decide to go on a strike, then we're bound to see even more restructuring of how profits and income generated get distributed, throughout the value chain. It's not something we can predict, but it's something we must prepare for because obviously the writers are necessary for these businesses to run. We have no good shows, no good movies, no good scripts without them. And, we may see lower profit margins as payouts start to happen at different stages to different parties. But I don't necessarily think that'll be a terrible thing in the long run. Just it would be different and it would take some getting accustomed to. Profits are super important as an investor, but I think at times it becomes all people look at. In this industry, profits cannot come at the cost of content quality. It has to come in conjunction with it, because otherwise the profit's not going to be sustainable. It's not going to last, which is why I think that companies should look to protect their employees, writers included, and also adopt a quality over quantity strategy when it comes to, outputting content. I would suggest keeping a close eye on how the next few years go with streaming and entertainment companies, as it does seem to be an industry with a lot of action and a lot of promise. I hope you enjoyed this episode, and if you did make it this far, I thank you for listening. Once again, I'm Anurag Birla, and this is Finance Now.